Hello traders, this is Fawad Razak, other market analyst for City Index. Today is the 24th of February. So the markets have bounced back in Europe following the German election outcome. That has helped to keep the German DAX index inside this bullish channel. But as I've highlighted in my report, which I've linked it to this video, there is a risk that we could potentially see a correction in the German market from severely overbought levels and because of some macro concerns which I've highlighted in the report. So please have a read through that if you're more interested. But from a purely technical point of view, the key level to watch now is the high from Friday's range, which comes in at 22,396. That level needs to hold as support now on a daily closing basis to maintain this short-term bullish momentum. Otherwise, if you go back below that, that could potentially trap the bulls and potentially lead to a drop, a more significant drop than we've seen in the last several trading sessions. The key level to watch below Friday's low is around the shaded blue region right here, where we peaked in January before the index broke above it. That area comes in at around 21,803. Below that, there's not much in the way of short-term support until 21,200 or thereabouts, marking these lows. On the upside, the next key level of resistance to watch is the low from this doji candle that was taken out following that big drop on Wednesday of last week we saw. That low comes in at 22,720, which now makes this a key resistance level to watch. Now, the US markets fell quite sharply on Friday of last week, as you can see on this daily chart of the S&P 500. Was that the top for the market? Remains to be seen, but what we do need to see is some downside follow through now to attract some selling activity in this market. But the long-term trend is clearly still bullish, so it remains to be seen how much further this will go before the buyers potentially step back in. But the trend line connecting the previous lows was taken out, so this is potentially a bearish reversal signal, especially if you look at the weekly chart. Here we have a bearish engulfing light candle on this time frame, and if you look at across the other major indices, you'll see a similar pattern, potentially suggesting that the bullish momentum is waning. Some would say about time, given how strong the markets have been in the last several months. So a correction of some sort will be welcomed by even bullish investors, I think, because that will make the markets valuable again for the buyers. But let's see if we'll get some downside traction from here. Now, going back to the daily chart, the key level to watch is 6,000, a psychologically important level on the S&P 500. This level was previously resistance and support on multiple occasions, as you can see by the wicks of these candles. We haven't got a daily close below this level since the market broke out above it in the middle of January. So if we post a daily close below this level, then that could potentially make things a little bit more interesting, and it could then lead to a drop towards this bullish trend line that has been in place since October of 2023. Below that, we have the 200-day moving average that might come into focus should the selling pressure continue. Gold has just hit a new record high, but it has struggled in recent days to really take off from here and rise towards that 3,000 psychologically important level, the level that everyone's really talking about on gold. Will it get there? Remains to be seen, but one thing to notice is the shape of these candles, small bodies and small wicks, really suggesting that the metal is consolidating, perhaps, or perhaps losing some momentum. So far, though, we haven't seen any real downside follow through. We've seen a few bearish looking candles, for example, this one that was created earlier this month. While we had a bearish engulfing candle last Friday, that didn't bring out the bears. Instead, we broke to a new high. So we haven't really seen downside follow through. Therefore, for me, the key level to watch, the line in the sand, if you like, is at 2,877, marking the low from that Friday's bearish looking candle. Should we break that level down, then we will probably see a deeper pullback towards potentially this shaded region, marking the October high. But we'll cross that bridge if and when we get there. For now, the key level to watch is 2,900, which is offering support on the downside. And then below that, as I mentioned, that 2,877 level, which is key now. On the upside, there's not much in terms of resistance. It is testing a potential resistance zone right here at around 2,950 area, marking the 161.8% Fibonacci extension from the most recent significant drop from the October high to the November low. That level comes in at just below the 2,950 level at 2,946. And so far the market is showing it some respect. But if we post a daily close above that area, I think that then could potentially pave the way for a run towards that 3,000 level. Let's see if it will get there. But I think, judging by how US markets fell on Friday, you just have to be a little bit wary that the markets can go up as well as down. So take nothing for granted, take it from one level to the next, and always make sure that you have appropriate risk management strategies in place when trading the financial markets. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.